Hello, good afternoon, good evening, everybody, or wherever you are. My name is Christopher Kummer, and on behalf of the Institute for Mergers, Acquisitions, and Alliances, it's a pleasure to welcome you to this webinar on common valuation mistakes and particularly sort of how to avoid them. It's a pleasure to do this webinar together with our partner Valutico, and to also welcome Markus Langauer and Alexander Harris to the webinar today. Just a very brief introduction if you don't know us already. The Institute for Mergers, Acquisitions and Alliances has been in existence for more than 15 years. We do a lot of trainings and try to help people and organizations improve or build capabilities, particularly in mergers and acquisitions, along the whole chain and the whole M&A process from strategy over due diligence, valuation, and post-merger integration. We have a global network of offices and people, and it's a pleasure to do this with so many participants over the years globally on a lot of cross-border transactions and perspectives. We try to provide the very best what we can in terms of content, materials, and learning opportunities to the whole community, which we are sort of building globally. And also just a very brief glimpse about an upcoming program that we will offer in December, particularly for valuation. So we're proud to sort of offer also a training with Professor Damodaran on valuation. So if it's not too late for you guys, to look into that or join, it would be a pleasure to welcome you there. And also we have a lot more trainings come up in 2023. And with this, it will be my pleasure to hand over to Valutico for today's webinar.
Excellent. Thank you very much, Christopher. Yes, so I will just try and share my slides with you all now. So hopefully they'll pop up in a sec. Here we go. So welcome to the webinar. We're very excited, very happy that you're all here to join us. Thank you for joining us. So today the webinar's on, as mentioned, common mistakes in valuation. I'll just give a very brief introduction into who Valutico are, and then I'll pass over to Markus to take you through the common valuation mistakes and allow him to explain what they are and how to overcome them. So Valutico is a business valuation software. That's what we provide. So it has on it about 9 of the leading valuation methods with about 28 variations. When you use the platform, you get access to about 50,000 comparable peers and about 1 million transactions. So it's kind of an all-in-one online platform. If you do valuations, that's what we've created and what we're mainly about. So we started in 2017 and have been growing at pace ever since. And now we have about 500 or way over 500 now clients around the world in about 75 countries. And we have team members in about 22 countries and speak all sorts of languages and deal with all sorts of markets. So, okay, we are used by over half the world's top 20 professional service networks. So we're used by M&A and corporate finance professionals, large financial service companies, as well as smaller consultancies, but also accountants, private equity firms, investment bankers, and anyone who does a lot of valuations really comes to us and generally finds Valutico software quite useful for them. So, okay, so on the left, you can see, as I just described, we have the Valutico platform, but we also have our sort of a consultancy arm where we provide valuations if you want to sort of outsource your valuation work. And we also do own specialist training and valuation as well, if you're interested in that. So today's webinar on common mistakes in valuation. This is the agenda for today. And so in a sec, I'll pass over to Markus. So the agenda follows a typical valuation workflow, and our specialists have seen mistakes occur across these stages, as you might imagine, from starting with the valuation assignments, which is the sort of definition of what you're doing, to then setting up the proper business model, which, a fundamental underlying requirement of valuation, and then also to errors found in the sort of flawed application of theory and methodology, and then also issues with reporting as well. Okay, so without further ado then, we'll get stuck into it, and I'll pass over to Markus.
Thank you very much, Alexander, for handing over on this. and welcome everyone to the common valuation mistakes presentation that I will be holding together with you. Throughout the presentation, please feel free to come in with comments after each of the sections that I will be discussing with you. Let's take a few minutes to gather some comments and some ideas. And I'll also make it kind of interactive with you in order to give you more insight into what we think and how we work. So we'll also ask you a couple of questions that we will then try to answer together jointly. So please feel free to comment your answers in the comment box, and we will discuss that and read that out afterwards. So we will start before we actually going into the mechanics of valuation. I would like to discuss with you the valuation assignment problems and the most common mistakes in valuation actually happen before the assignment has even started. It's the definition of the valuation perimeter and the definition of the scope. So Alex, if we jump on to the next slide. I've taken a very recent example of what might be a valuation assignment that you or your clients might request from you. And I've taken the FTX crypto dealership platform here that has been on the media quite recently. And the most common question here is, well, if you had an assignment, a valuation assignment, to value that kind of company, the first question that you would have to ask as a valuation professional is the definition of what am I actually valuing. So the administrator, the insolvency administrator, has drawn up those 4 silos of FTX, of the FTX company. And within those silos, you see a couple of assets at the bottom of the screen in those 4 boxes. And for you as a valuation professional, it's of utmost importance to understand on what the actual assets that you are valuing, what they are, right? So if you have to value cryptocurrencies, that's a completely different story than if you had to value real estate or if you had to value a company. And I think it takes some time to really understand and to also make it clear with the client to define the perimeter of your valuation and the perimeter of any transaction. And you can save yourselves a lot of headache if you go through a very thorough assignment definition and a thorough definition of the scope. And it will spare you some work. It will spare you some miles that you're going and then have to circle back. And it will define your valuation assessment properly, and you will come up with a proper plan in order to go through the valuation assignment. Now, let's try that example in practice. And the question to you is, you all are aware of the company Volkswagen, a German car manufacturer. Now, Volkswagen, we all know the company, but now the question to you, and I would like you to answer that in the comment section, is how would you value Volkswagen? How would you tackle that? And we've prepared 3 possible answers for that. And would like to give you a couple of seconds here to provide a couple of answers here in the comment section, which you see on the right-hand side of your screen. So the first answer would be, we'll just go with the discounted cash flows or discounted earnings valuation of VW Group and apply discount rates for vehicle manufacturers. The second option would be, let's just use trading and transaction multiples for vehicle manufacturers. And the third one would be, we'll use a discounted cash flow or a discounted earnings approach of all of the VW entities, so some of the parts story. And then we apply discount rates and multiples for vehicle manufacturers as well as banks or financial services. So do you see the first answers coming in? Okay, I see the first answers coming up with answer C based on different discounted cash flow approaches in different areas, which I like a lot. I think we can reveal the right answer that we would tackle here. If we jump over to the answer, yes, this is also the way that we would tackle the valuation of Volkswagen. Why would we do that? Why would we choose a DCF valuation or discounted earnings valuation of all of the entities separately? I mean, after all, VW is just a car manufacturer. Well, that's again ties back to what I said initially about the definition of the scope and about understanding on what the asset that you're valuing actually is. So if we look on the next slide, we will see that Volkswagen Group is actually not just a car manufacturer, but it has a significant financial services division attached to it. So saying that Volkswagen is an automotive producer with passenger cars and maybe commercial vehicles would just be not really fully understanding of what the group actually is and omitting a significant portion of its business services. So I think it's really, really crucial to understand the definition of the valuation perimeter before even starting your assignment. And this is the first point of the valuation assignment questions that I would like to discuss with you. The second one is we need to understand that there should be a clear distinction between company and private assets. Now, what does that mean? If you look at Volkswagen Group, that's very clear, or should be very clear, that all of the assets that we find on the balance sheet of Volkswagen Group should be company assets, should be corporate assets. Of course, there might also be some assets that might be up for disposal, but in principle, the balance sheet of listed companies should be all used for operational purposes. However, this distinction is not always so clear, and this is especially true if you are going into valuations of non-listed companies, of private companies, or of SMEs that might not even be incorporated. So if we see that on the next slide, one key criterion for a proper definition of your valuation assignment is the identification of the company versus private property. Now, as I said, with listed companies, it's typically very clear. If you have a lorry there in the company, it's typically company property. If you have a factory building or an office building, it's typically company property. But in my career as a valuation professional and also as a banker, I've seen companies that might not be so straightforward in terms of the balance sheet structure. More specifically, I've even seen company yachts being booked on the accounts of a company. I've seen company Lamborghinis or Ferraris booked on the accounts of a company. Now, while that might be very legit if they were running a yacht leasing company or if they're running a car dealership, it's typically not really common to have a company Lamborghini for all of your staff on your balance sheet. And those assets might actually be private properties. And therefore, you would have to identify as a valuation professional on what is really the subject of your valuation and what is not. One fun fact, aside from those two kind of assets that I've seen on balance sheets, we've also seen some expenses that were booked on company accounts that were actually considered to would have been private expenses. We've even seen college tuition fees booked in a company, and they would clearly have been private expenses of the owner family. So if we wrap it up, the first section here, the definition of the valuation assignment of the valuation perimeter and the identification of company and private property is crucial to your valuation assignment from the very onset. Whatever you do wrong here in the first place cannot be mitigated by an excellent execution of the valuation mandate. But in fact, anything that you do now will come back to you at the later stage of the valuation process. Now, if we jump on to the next step, as Alex has already outlined, once we've specified the valuation assignment, we will jump into flaws and errors that happen on the business model. I've again split split that section up into two segments, one being adjustments and normalizations, and the other one being business plan constraints and constraints of the business model that might lead to a flawed set of cash flows being derived from the model for your valuation exercise. So one aspect is the adjustments and normalizations part. If we jump to the next slide, what's typically done in case of any valuation is adjustment of historical financials. So the key question here is, how does the past reflect the future? Or to put it differently, do the past financials reflect the outlook for the futures appropriately? And are the past financials a starting point, a valid starting point for an escalation, for an extrapolation of earnings, of growth, of margins to the future? I think one of the most illustrative examples on that is Bayer company, the German pharma giant, that had a revenue distribution in its segments of close to 50% in the pharmaceutical segment and 25% in the crop science segment. And that was the revenue distribution in 2017. And now you all might be aware of what happened between 2017 and 2019, just 2 years. What Bayer did finally, and this is, I think they're still working on that to integrate the company. They bought for a consideration of approximately 63 billion US dollar. They bought the crop science giant Monsanto, and thereby transforming their business model or transforming their top line from a mostly pharmaceuticals company to a half and half crop science company and pharmaceuticals company. So any of the margins that you would have seen in Bayer company and would have used for an extrapolation and doing forecasts in 2017 would not have been relevant 2 years after. So what is key for any valuation is the three main drivers of any valuation, which is growth, or growth perspective of revenues. Then you have cash flow conversion, which is effectively margins, EBITDA margins or free cash flow margins, and is the risk outlook. So the key question that you would have to ask as a valuation professional in that case is, what is the impact of the segment shift on those three drivers: growth, revenue growth, margins and cash conversion, and risk? And if you can have a proper statement about that, then you're a professional valuation analyst, and you should really discuss that with management and assess whether the historicals are the right, or is the right base, whether historicals are the right basis to do the extrapolation, or if you need to run your own proper assessment of how the business might look in the future. Now, to be more specific on that aspect, I would like to jump to the next slide, in which we'll see on how forecasting is different from just an extrapolation of the past. So there's two aspects to it. One is adjusting historicals to make them an appropriate basis for extrapolation. And the second one would be sort of the key challenges of client-created forecasts that you see on the right-hand side. So typical adjustments to historical financials, and I think most of you are aware, is especially one of revenues and expenses. So that mostly relates to extraordinary sales events or extraordinary cost events that might have occurred. Something that's also very common is payment terms for suppliers and customers. They might have changed in the past, and they might be different tomorrow from today. Other topics include things as favorable interest rates or payment conditions that would then be changed. What we often see in our valuations at Valutico is that the tax regimes in the future will differ from what has been the case in the past, and that needs to be accounted for as well. And what has been a recent development, especially on the energy prices side here, is that the expected cost realities might differ significantly from what we have experienced in the past. So at the bottom left, I think it's rather small, but you would see the European electricity or gas prices, and those have shifted significantly from a very favorable environment and have shifted to actually a burden of company models and business models throughout Europe. The second point is the key challenges that I already mentioned of client-created forecasts. I think all of us, if you have been working in the valuation and forecasting sphere, have seen hockey stick plans, hockey stick forecasts, which basically come back like every day, Groundhog Day. So whenever you see a corporate plan, it's typically rather ambitious. Then it doesn't really materialize, something has gone wrong, and the plan is revised, but it's again revised to another hockey stick. So it's a perpetual movement of hockey sticks. And as a valuation professional, one of the most common mistakes is to actually believe those, but instead we would typically, or it's actually typically the mandate that we have, is also to challenge the business plans that we receive from management. Another point is that the assumptions are not really consistent, that revenue growth doesn't really make sense, or that people just escalate their business plans with inflation without taking into consideration the volume components or the price components. Another mistake is that scenarios are typically not something that is very prevalent. I think it would benefit the quality of business plans a lot if more valuation professionals and more corporates would use scenario analysis in their business plans as opposed to just one sort of base case management case. All right, so that's it in terms of the historical adjustments and future developments. The next one is sort of an exercise that we've prepared for you. Is on business plan constraints, and I've prepared a little case study for you on an underground cavern storage asset, which I've worked on in the past. And it's effectively you buy a hole in the ground in which you can pump water, liquid, whatever, and that you operate. So you buy a company that effectively has one asset, and you pay a price premium for that, which then materializes in the fixed assets and in the equity or on the capital side of the balance sheet, and then generates the pattern that you see here. So the next question to you would be, what would be the problem of that kind of business plan? What constraints do we have in that business plan in terms of maybe valuation, cash flow side? I would like you to post that in the comments if you have any. So I'll give you a minute to look through that, and then we'll come to the question. So if we now look at the issues with the business plan, and the question would be, which of the following issues comes with the business plan? And the first answer would be, well, the covenants would be breached. The second one is we run into a cash trap. And the third one is we run into an investment shortfall. Maybe Alex, if you jump back to the business plan itself to answer those questions. So if we jump back to the question here, the question was, which of the following issues comes with the business plan? A, covenants breached, B, cash trap, or C, reinvestment shortfall. And we'll just find the solution, which is a cash trap. We run into a cash trap if we look at the balance sheet overview on the next slide. So what's happening there is the company creates a significant cash flow, and capex are significantly lower than depreciations, because we depreciate the value of the asset which we bought for a premium price. I mean, the hole in the ground that we see here doesn't need any reinvestment or any significant reinvestment. It's just there, and the investor buys it or bought it and would then run it over a period of time. What you would end up with is a squeeze on the difference between distributable equity and cash flow, which is then a typical cash trap that you can run into, and that materializes, and you see that here on the balance sheet overview, in a cash position that cannot be distributed to the owner of the company, and therefore leading into a problem for the owner in order to extract the cash flows, which might be a serious issue in your business model. And if you have not catered for that, that is one of the mistakes that we see most frequently in business plans. Now, that's one aspect of the business plan constraints. The next one are constraints that are, or flaws that we frequently see in financial models, and constraints that come from a regulatory or factual constraints. So we've already touched upon technical cash traps. What we oftentimes see as well is that working capital requirements are not really reflected accordingly in business models. That's especially true for companies that exhibit a high potential of growth and a high growth in its revenues in the first years. Another topic that is very common is that operating cash requirements are not reflected whatsoever. The most prominent example for that kind of problem would be retail companies. Any retail company requires operating cash on their cash desks in order to run. If you're just deducting cash from your net debt position, then you would be omitting the fact that the company actually requires cash as sort of their working capital stock. Another topic that we'll be touching upon later is defined benefit obligations, so pension provisions that are treated as operational debt that are typically actually net debt as opposed to operational liabilities. And something that we see in valuations that are based on discounted cash flow models is cyclical reinvestment requirements, which means the capex aren't spelled out properly and aren't modeled out properly. That's typically a problem for more cyclical industries, such as the oil and gas industry or such as manufacturing companies. Now, that's one point. Those financial model constraints would typically lead to cash flows that are not modeled out appropriately in the relevant business model. The other one is more abstract, I would say. Regulatory and factual constraints can refer to constraints that are imposed on a company by external parties, third parties. That could relate either to loan covenants. So you might not be able to distribute the cash that you generate due to a loan covenant, maybe an equity covenant. Sometimes assets are regulated, especially infrastructure assets, which would then mean that the definition of your P&L follows a very, very different logic from what you are typically used to. The same goes for capital requirements that banks typically have. We are all aware of Basel 1, 2, 3, maybe 4 regulations. Some of you might be familiar with project finance, and in those you also have contractual obligations to maintain reserve accounts for maintenance reserves or for debt service, and those accounts also need to be modeled out properly. In short, those kind of business plan constraints are one of the most seen flaws and errors and mistakes that we see in valuations. And there's actually only one way around that, is a proper business model. So your business model needs to appropriately reflect the cash flow constraints in the business model. And for those of you who like multiples valuation, it can be really tough in that respect, because multiple valuations typically cannot really account for these kind of constraints. So in any case, if you want to have a meaningful valuation, you can go for a multiple valuation, but you should back it up with a cash flow based valuation model. And I think we can also help you out with those if it's required. Now, that's it on the second layer of our presentation for today. We've now touched on the business model topics, and the business model ties very, very strongly into the third part. If we can jump back one slide, when you have the business model at hand, when you have the business model prepared, you can simply link your business plan to the Valutico export sheet. And then use it in a single export tab in order to upload it to the Valutico platform. And this is where we will be moving now on the third section here, valuation techniques. What does that mean? Valuation per se, once you have the business model, is merely a technical exercise of appropriately discounting the cash flows, using the right discount rates, using the right cash flows, merging them together in order to derive a value. Now, there are two main issues that we see very frequently in terms of valuation techniques. One is that discount rates aren't matched with the correct cash flows. And the other one is that debt-like items and non-operational items, which I've already touched upon in the earlier stage, are not reflected correctly or incompletely. And we will see that in a second when we jump over to the Valutico platform. So let me take over here the screen from Alex and present you my screen, which you see here. Excellent. So what you see here is the Valutico platform, and actually already the output of one of the valuations that I've just run for this presentation here. I've valued Deutsche Lufthansa, which is the German aviation company that had just raised another capital or another set of equity after the downturn that was due to COVID. When I said earlier that there's two main topics, is mismatching discount rates and mismatching cash flows. What we see here actually illustrates that quite well. So you have different approaches in valuation, which you're all familiar with. You, on the one hand, have entity approaches, which value all of the assets of the company and then deduct net debt in order to arrive at the equity value of the company. And on the other hand, you have equity approaches, which come up with the equity value of a company from the very onset. Now, one of the most basic mistakes, and actually one of the most common mistakes, is that people come up with maybe discounted cash, with free cash flows for the discounted cash flows model, and would then use cost of equity to discount their cash flows. Now, this is conceptually and fundamentally wrong, and that oftentimes happens with more junior professionals who haven't done so much on that. Even though this is a very basic mistake, as I said, it's very common. The beautiful thing about Valutico as a platform is that these kind of errors can simply not happen if you use the platform. Once you have set up your proper valuation business model that I've shown earlier, there's simply no way that the platform would take a cash flow item and discount it with the wrong discount rate or with the wrong multiple. Now, we see that here, further down. Sometimes what we also see very frequently is that people use let's say an EV/EBITDA multiple, but instead of using it or applying it to calculate the equity the enterprise value of the company, they come up straight away with the equity value of the company by using that kind of multiples, which we also have in Valutico here in the peer selection, which you see here. You see EV multiples, EV EBITDA, EV EBIT, but you also see equity multiples, price earnings, and price book multiples. And what happens very frequently, as it is the case with discount rates and cash flows, is that people apply the multiples to the wrong metric. So sometimes we've even seen that the people are using EV EBITDA multiples and applying it to EBIT, and then not deducting net debt to come up with something. So anything that could possibly go wrong went wrong in that case. The beauty of Valutico is that this cannot happen, as this is a fully integrated valuation platform that would do all the work for you. It always recalculates and recreates the valuation if you change any of the parameters there. So that's the error on mismatching discount rates and cash flows. The other item that we see very frequently is the reflection of debt-like items and non-operational items, and I've prepared that already for you further down here. What you can see here is a typical EV to equity value bridge, in which you typically have the enterprise value deducting net debt, or deducting debt and adding back cash in order to arrive at the equity value. Now, something that we see very frequently, especially in valuations of German companies, is that pension provisions and other debt-like items are not reflected appropriately in the valuations and are thereby omitted altogether. What we see very frequently is that also on other platforms that we see is that debt is just financial debt, is just considered financial debt. Sometimes people even omit lease liabilities, which are neither reflected in the EBITDA, nor are they reflected then at the later stage as debt, as they're not specified as financial debt in the financial statements, and then they're omitted. I've seen multiple valuations in the past, let's say, 4 years since the introduction of IFRS 16, the corresponding accounting standard that omit either pensions or lease liabilities that we see here. Now, Valutico can take care of that in a very simple manner. If we go back into the business plan, you can build that bridge for yourself. If you have a business plan, if you've made your financial projections, and you're aware of the topic of the debt, it's just a one-line item that you can then use in order to specify the EV equity bridge, which then allows you to specify the items that you want to add or deduct from your valuation bridge. You can also have the possibility here to add a custom item here, which is something like that I will do now, is non-operational assets. And in that case, we would deduct the value of those non-operational assets. Say they have another 100 million of assets for disposal on their side. And then you would add that to the valuation bridge. What Valutico cannot do is it cannot take off the work of discussions with your client. But what it does is, once you have that discussions and once you've held that discussions, it will meaningfully show that in your EV to equity bridges, and then allow you to specify what your debt items and net debt items would be. Now, coming back, and we see that here on the discount rate side, to what I said earlier on the mismatching discount rates and cash flow sides. I think one of the huge advantages of Valutico is that it's a very transparent platform that allows you to change the valuation parameters, especially the discount rates, very, very easily, and just with the click of a mouse. So if you say that you're not comfortable with the unlevered beta that flows into evaluation because you believe that the riskiness of the asset should actually be much higher than just 0.74, then you can come up with a beta of 1, update the valuation, and the whole valuation would change within a second or two. So now with our valuation, we arrived at the value of 24.2. If we say that we want to change the risk-free rate to 3% because we believe that the interest rate environment will change significantly or has changed significantly, then you will see here right at the top on how the valuation can change. So all in all, Valutico is a very, very flexible tool to apply the valuation techniques. Maybe Alex, you can take over again. To apply the valuation techniques in an integrated form, in an integrated tool, and that helps you avoiding errors in your valuation practice. Now, that's the part. Exactly, I've plotted here what I said earlier on the mismatching discount rates and cash flows. So you just need to be aware of what discount rate you use for your valuation. For a discounted cash flow, for a flow to equity valuation, you would typically use the cost of equity, whereas for a discounted cash flow WACC approach, you would use the free cash flows and then apply the weighted average cost of capital to arrive at your enterprise value as opposed to the equity value. If we jump one slide further, it's the debt to equity bridge that I mentioned earlier, is also something that you can find in the financial statements of the company. What we see here is the valuation of Lufthansa back in 2019. So we assumed that had an EBITDA of approximately 5 billion euros at the multiple of 3 times EV/EBITDA would yield an enterprise value of 15 billion euros. And now the question on that side here is, now which of those items would you define as net debt? And as I said earlier, pension provisions make up a substantial part of Lufthansa's debt, which in the case of our valuation on the Valutico platform was reflected in the EV to equity bridge, which we can see again here in our EV to equity bridge. Now let me just jump over. Yeah. You see the pension provisions are reflected here in the Valutico model, which makes then a more appropriate valuation. Now, let us set aside some time for digesting these kind of topics that we already discussed, and I would be open for a set of questions before we move on to the last point, which is then the pitfalls that you could potentially have in reporting, which is then the last aspect of today's webinar. So please feel free to ask any questions on what I said up to now, especially on the topics of flawed valuation techniques and business model mistakes. And maybe there's also one or the other question on how to implement that in Valutico, and we'll try to come up with answers to your questions. So I'll just take 2 more minutes or 1 more minute to gather the questions, and then we'll jump to the last point, in which I will show you the powerful reporting export function of Valutico. So please feel free to answer to type your questions in the comment section on the right-hand side. So one of the questions that we have here is, where does Valutico take betas from? What Valutico does is that we calculate our own betas based on a methodology. I'll show you that here. Based on the methodology that we use 5 years betas here. You can see that here. We run our own regression analysis, and the database for that is largely Capital IQ data, especially on the stock market prices. So there was one question on the betas. You can, of course, if you have your peer selection in the betas, you can always change that and say, okay, well, EasyJet is probably not a good peer for Lufthansa as it's not a premium airline. You can always take that out, and then you will find that beta here in the beta section will also be removed. The question is here, is it industry betas or is it company betas? Here we have both, actually. We have the company betas, which are shown here. I'm not sure if you can see that. Yes, you see the American Airlines beta here of 0.30, and you see Wizz Air beta, and then what we come up with is the peer median, as you would typically do, which was the 0.74 that we had earlier. But what we also have is the airlines industry, the industry median, which is significantly lower here. So we have both industry as well as company betas. Are there any other questions regarding how Valutico works, or how the what the pitfalls of valuations might be? If not, then I would like to show you something that reflects the fourth part of, or the last segment of today's topic, which is the pitfalls in reporting. I think you've all done valuations on your own, and maybe the most painful part of valuation is then sitting down and typing the results of your report into either a Word document or a PDF document, and then issuing it to your client or to your management and presenting the results in a meaningful way. One of the strongest Valutico functions is a customizable valuation report export function, which we see here. We have that in, 7 languages, 6 languages now, and we're always improving. And at the very moment, we are also improving on making the reports more flexible, more customizable. But what we see here is, I would like to just show you the indicative valuation report for Lufthansa Group that we just did. So if you click on export, it will take a while to load. I've prepared one already beforehand. And this is just the plain vanilla Valutico standard report, but it's always customizable to your needs, be it on colors, be it on content. You can always come up with also with your own color expectations, and our customer service would help you in setting up, defining your very own valuation report. And that is actually one of the functions of Valutico that will save you the most time. You can select or deselect, so whatever you do in terms of valuation approaches that you have chosen here will then always show up in the Valutico export report. You can also see that here is the net debt bridge that we did earlier is reflected here in the export. You see the peers, the multiples that you've selected, and literally there's everything that you could possibly need in order to explain your valuation. But you can also trim it down. So if you just want a very, very limited set of slides to be presented, then you can specify that in the Valutico templates, and you can use placeholders, but I would recommend you to reach out to our customer service team, who will help you then with creating these kind of export templates. Now, if we come back to the initial agenda that we had for today, we had 4 topics. On our page 6, we had valuation assignment topics, we had business model mistakes, and we had flawed valuation techniques, and we had reporting pitfalls. What Valutico takes over here is not the entire workflow. That's still up to you to define the valuation assessment for yourself. So this is sort of where you come in as valuation professionals, is the definition of the valuation assignment and defining the business plan. Yes, we can help you in supporting building a business model, building a business plan, but where the power of Valutico really comes in is when you have the impression that you're not up to speed with valuation techniques, or that you need some support on valuation techniques, or making your valuation techniques more efficient and making your reporting more efficient. This is where Valutico will come in with our suite of 3 different kind of offering, which is one, the Valutico platform, one other stream being Valutico consultancy, and the other one Valutico trainings. So yeah, thank you. So if there are any questions, please type them in the comment section. Let's take another minute or so. And if there are no questions, then I would hand back over to Alex and Miriam for the outro. So I will stop sharing my screen now.
Thanks, Marcus. That was excellent. Very, very good, and very interesting, very in depth. Thank you for covering all those topics. Yeah, cool. So I guess we'll give it a minute or so to let people ask any questions if they have any questions on how to approach valuations, our experience with the mistakes that are often made, any of the content that's been covered so far. So we'll just hang around for a minute or so and let people type their questions into the comments if they have any. So one question that's come up on before is Valutico sort of relevant for sort of smaller owner managed businesses? Because it's very difficult to find any listed companies that are similar.
So the question is Valutico useful also for the valuation of smaller companies and for creating valuations for non-listed companies?
Yes, that's right. Yeah.
Yes, Valutico is useful for any kind of valuations, as long as you can deal with sort of the flexibility that you can handle a business plan properly. It doesn't really matter whether a company is listed or not listed. Yes, you will find peers and benchmarks largely only for listed companies. But what really matters for any valuation is getting an idea of what listed companies might trade at and what the risk perception of listed companies is. But what really matters for any valuation is a fundamental business model that is underlying any valuation. And this kind of model exists or should exist for any of the companies. We can help you support your valuations with benchmarks. We can help you support your valuations with listed multiples, and obviously multiples are only there for listed companies. So sort of this is a limitation not of Valutico, but a limitation of the fact of how valuations are conducted in the sphere of transactions. And trading multiples. However, one thing being said is that we do not just offer trading multiples of listed companies, but our transaction database also includes private transactions that happened in the past, and so you can also have access to this kind of information for your valuation purposes.
Cool. Sounds good. Okay, let's try and just jump on to the last slide here. If I can share my slide. So it's worth me saying at this point, if anyone has any interest in learning more about any of the things that have come up, so the Valutico platform itself for conducting valuations, valuation training, if you want to learn more from us, or also if you want to outsource your valuations or get any consultancy help on your valuations, get in touch with us. There's many ways. One of the ways is just to get in touch with me, Alex Harris, so at a.harris@valutico.com, or you could phone me if you wanted. Otherwise, you can visit our website, valutico.com, and you can book a demo there directly as well. Sales@valutico.com works as well. But yeah, otherwise, thank you very much, Marcus, for that. And so Miriam, shall I hand over to you now to say goodbye?
Yes, thank you very much for being part of today's webinar. We are looking forward to welcoming you to our next webinars and trainings. If you have any questions, feel free to write us an email to info@emainstitute.org. Yeah, so have a nice evening and bye.